destination, be it do you need an independent regulator? Is there a perspective with respect to risk reward on concession agreements and with respect to timelines and process? Truly educational and very good insights. Thank you once again. Our next panel, in fact, it's not a panel, it's a presentation on alternatives in 2022 by Shifra Ansonoff, who is an EVP, Global Head of Research and Data Operations from Preqin. Welcome to Shifra.
Hello, thank you so much for having me. My name is Shifra Ansonoff and I run the Global Research Division at Preqin. Just a bit of background on Preqin. Preqin is the go-to for data, solutions, and insights on alternative asset classes. Our data model relies on the collection of data across the globe to provide the most up-to-date information contributing to comprehensive data sets for private capital and hedge fund asset classes. First, I will speak in this webinar about some relevant goals as they relate to private equity venture capital, and then segue into specific findings from our 2022 Global Venture Capital Report. One of the key ingredients to success in life is setting measurable goals, and to get us there, we make atomic changes to our habits that lead us to successfully achieve them. And it's these atomic changes that seem to be the most difficult. Studies show that only 20% of individuals who set New Year's resolutions actually carry them out successfully. And other studies show that rather than setting an arbitrary date, many successful achievements are on the back of a trigger. Events like what we've experienced around the world in the last few years with COVID have indirectly spurred innovation and ideation across a multitude of sectors, whether they be health tech, ed tech, fintech, or clean tech. And it is quite interesting that in the past year, specifically brought to bear a record number of unicorns and IPOs. Specifically in India, we saw 46 unicorns in 2021. And we've seen these startups raise multiple rounds, increasing valuations multiple times over. And the name of the game is adaptation. And the industry is adapting. When we look at the data more closely, with the bounce back of markets in 2021, as we've seen, all asset classes of alternatives grew in AUM versus 2020. The asset classes in aggregate that we classify at Preqin as alternatives include private equity and venture capital, private debt, real estate, infrastructure, natural resources, and hedge funds. And as we can show on this slide, we're projecting that assets are increasing from a level of around 13 trillion in 2021 to hover above 23 trillion in 2026 at a CAGR of 11.7%. In addition to the rising valuations and strong performance, as we'll see shortly, fundraising markets have supported this AUM growth in recent years. Now, if we were to carve out the private equity venture capital portion of the assets under management, this is the largest component. And if we were to then slice this in between the private equity and venture piece, private equity assets are approximately 3.65 trillion as of 2021, expected to reach 7.62 in 2026. If we assume a level dry powder of around 2.5 trillion, the unrealized value would be 5.15 trillion in 2026. And if you were to compare this level to public equity markets proxied by, say, the MSCI ACWI index around 66 trillion, it's obviously a small proportion with room to grow. Now, on the VC side, VC AUM decoupled from these numbers tripled from 537 billion in December of 2016 to around 1.7 trillion in 2021. And VC AUM is expected to hit 3.5 trillion by the end of 2026. Now, drilling into VC, looking at the chart on the left, 2021 was a record year across the board. Record exits, some of the highest priced IPOs for VC-backed firms, Coinbase at 44 billion, for example. And if you look at the chart on the left, you can see the highest amount ever raised in a single year by VC funds, 187 billion, up from 161 billion in 2020. And what's interesting is looking at the blue bars, you can see the number of funds has decelerated over time. So what that means is more capital is being raised across a smaller number of funds. And this can be because valuations are higher and managers are forced to commit more per deal. Also, institutional flow is commanding larger ticket sizes, and there's more demand for returns. Successful fund managers who usually raise large successive rounds each time they go to market. Furthermore, if we look at the forecasting trends on the chart on the right, we can see that we're projected to exceed 200 billion starting in 2025 to reach 209 billion for venture capital. Now, as dry powder swelled in 2021 and was approximately 355 billion in March of 2021, VC firms put capital to work, investing 476 billion across 15,000 plus deals. And that was captured in the first 3 quarters of 2021. This is up from 315 billion across 18,656 deals in 2020. Clearly, VCs are putting a lot more capital to work, likely because of rising valuations, which have moved up substantially as they tend to, along with the direction of public equities. We also saw in India, Flipkart raised 3.6 billion last July, by far the largest for any Indian startup in its pre-IPO round. At Preqin, we also conduct surveys of investors and fund managers. And when we surveyed respondents on what was the biggest challenge facing them over the next 12 months for VC returns, they both were aligned in citing asset valuations. Now, despite projections of slower GDP growth and regulatory uncertainties in markets such as China, we see abundant opportunities elsewhere in Asia Pacific. Venture capital AUM in Asia Pacific has seen the fastest growth regionally, up 20% to reach 762 billion in 2021, of which 132 billion is actually dry powder. Now, we're also seeing, if you look at the chart on the right, larger funding rounds and capital concentrated in Series B and D rounds in the later stages, perhaps because of the macroeconomic headwinds. And while the number of funds and deals raised softened in Asia Pacific in 2021 in APAC, as well as mirroring the global themes we just saw on the other slides, the aggregate values were quite notable. The largest deals in Asia Pacific were spread across China, Singapore, India, Indonesia, and South Korea. And the largest deal of 2021 in Asia Pacific was Grab Holdings at $40 billion. And although the value has more than halved since then, it seems to be a very reliable service from my experience here in Singapore. In India, we spoke of Flipkart. And as well, in India, the year started furiously in 2022 with $4.43 billion raised in fundraising by startups, a quadrupling of the level seen in January of 2021. India now challenges China's lead in attracting VC capital. Pandemic lockdowns have accelerated digitization, propelling sectors such as digital payments and e-commerce. In Q3, as shown in the chart on the left, India recorded $14 billion in VC deals, almost a doubling of the 7.4 in Q2. And in the same quarter, edtech firms such as Sorting Hat Technologies, Bijou's under parent Think and Learn, and Upgrad Education drew in billions of dollars, especially after China closed doors to edtech investments. So how did VC perform last year? Exits reached record heights. Vintage 2018 funds reached median net IRRs of 30.3%. Looking at the chart on the left, the black line, this is the highest of any asset class for that vintage. Expansion late stage reached 37% median net IRR, likely because of the large number of highly valued exits in that time frame. And top quartile IRR boundary hovered above 47%, and the lower boundary was at 15.4%. And across all sectors, there were a record number of exits annualized. And even though there's only 3 quarters shown in the chart on the right, we can see the aggregate value exceeding 410 billion worth of exits. And that's up from 366 billion in 2020. With all this growth comes fanning out and expansion. Crossover funds, which are hedge funds and private capital vehicles like Tiger, have increased their activity in VC in recent years. 2021 recorded 854 deals in 3 quarters with participation from crossover funds. This is up from 577 in all of 2020. The value of these deals were far higher, approximately 126 billion, a doubling of the level seen in 2020. On Tiger's front, they recently released a statement, though, that they will refocus their allocations toward their earlier rounds, A and B, following the tech sell-off recently. And venture funds have also expanded beyond their borders. In Israel and Latin America, as shown on the chart on the right, we saw more deals involving non-domestic investors. And there are multiple reasons for this. One, investors are increasingly looking to emerging markets. Two, investors are looking for specific tech venture ecosystems that exist in certain markets, like cybersecurity in Israel. Three, COVID leveled the playing field. No one met in person, so it didn't matter. Thank you, Zoom. Now, on the inflation front, inflation is obviously elevated. I can only tell you how high my grocery bill is. And on the VC side, we've run empirical studies of inflation versus venture capital and actually all asset classes of alternatives. But we don't see a strong empirical relationship. Instead, what we do see with VC is the impact in the aftermath of inflation. So, to combat inflation, rate hikes are often instituted, and these higher rates result in lower valuations. When rates are higher, we tend to see investors allocate away from the riskier asset classes like VC and toward the interest bearing types of securities. Now, the figure on the left shows this relationship, though not so strong, but that as rates are going up, we see the aggregate capital raise coming down, reflecting risk tolerance. And the chart on the right shows a similar relationship between rates rising and the number of deals. So when we see rates on the low end, more VC deals are completed. Now, switching to ESG. An ESG play in VC is less about environmental controls and carbon neutrality, but more about the opportunity for impact. Venture capital represents that opportunity for investors to have exposures to technologies that really move the needle. And we believe VC backed firms will lead the energy transition. And these sectors include electric vehicles, battery storage, carbon capture technology, water and waste treatment, agritech. As the charts on the left indicate, clean tech has clearly had a record year. Aggregate exit values soared with over $10 billion of exits in the 3 quarters of 2021, compared to almost 300% increase over the 2019 figures. Now, the aggregate value of exits rose as well. We can see on the chart on the right, 461 million in 2021, up from 384 in 2020. Clean tech companies were also a favorite target for SPACs. So where do we go from here? On the back of the record fund performance and surging interest in technology sectors, aggregate VC fundraising will increase in the next 5 years. We're forecasting that venture capital funds will raise $209 billion in 2026, 12% above that in 2021. VC's annual fundraising CAGR between 2022 and 2026 will be 4.4%, behind the forecasted growth rates of only private equity and infrastructure. Second, we see market players from both private equity and hedge funds stand to gain from applying their expertise in the VC space. More hedge funds are likely to follow in the footsteps of Tiger Global Management and invest in tech companies while they're still private and more reasonably priced. This will position them to secure allocations in an IPO and benefit even more from growth and an increase in market value. Also, we see that private equity funds will consider late-stage venture vehicles. Finally, we predict that valuations of VC-backed firms and publicly traded companies in sectors that have been unsustainably high, like tech, electric vehicles, will come down, and we have been seeing them come down. Macro developments such as inflation pressure and subsequent rate hikes will put downward pressure on valuations. But even if interest rates rise a few percentage points, investors will continue to favor the venture capital sector. Thank you for having me. Exciting changes on the horizon as we look ahead to the wonderful innovation ahead of us. At Preqin, we're here to help with your data needs, so feel free to reach out to me to continue the discussion. I'd also like to draw attention to our Alternatives in 2022 and Women in Alternatives 2022 reports, which we will give complimentary access to all attendees today. They will be available in our booth, and at the end of this presentation, we have QR codes where you can scan them to download. And with that, I'll hand it off to the moderator.